Right, I'd like to welcome everyone to our Fortis concept overview. And I know that a lot of you have shown a lot of interest in this, or there has been just frankly a lot of interest. And so, one of the things that I wanted to do is come out with this quick overview of the Fortis concept that's going to allow you to, at your own leisure, take a look at what we're talking about. And then for those of you who are interested in what you hear after this, I'd like for you to get a hold of your agent or contact me, and we can walk you through next steps and things to happen. So first of all, I'm going to introduce myself. My name is Scott MacDonald. I'm the CEO and founder of MacDonald Financial Solutions. I'm also the Vice President of Advanced Market Services with Agents First. I am a financial strategist and wealth building consultant, and I have been doing that in some form or fashion for about the last 20 years. And I've got about 60 licensed advanced market agents right now with my organization that are ready to serve you. So I just want to kind of give you a little bit of an idea of who's on this video talking to you. So I want to talk for a moment about industry disruptors, because one of the things that I've found within financial services and the financial market is it is very easy for us to do what we've always done, to think how we've always thought or have been told to think. And I want to talk about a few industry disruptors because, frankly, I believe you're going to see that what we're talking about is going to disrupt the financial industry. In fact, it already is. Very similar to some that you're going to see right here. So the first company I want to talk to you about is Netflix. Now, I don't know how old you are, but most of those who are my age remember the company Blockbuster. Remember the different video VHS movie companies, movie stores out there. Every Friday night it seemed that we would rush to Blockbuster before everyone else got off of work, and we would try to find the new video that had come out. All of a sudden, they're not around anymore. And this company called Netflix came out and changed the way that not only we watch movies, but that we watch television now. And if you take a look at what has happened, they came with a concept that all of a sudden changed the industry. Or how about Apple? You remember, again, back in my day, we had Walkmans, cassette tapes, 8-tracks, depending on how old you are, CDs, records, all of those things. And Apple changed with the iPod, and Apple Music changed the entire music industry, and frankly the technology industry. Industry disruptors. Or how about Uber? And the fact that Uber was able to disrupt the transportation industry. Taxis. Most times you see taxis now that have an Uber and a Lyft sticker on the inside of them. What did they do? They came with something unique and disrupted the industry. Or, we've all heard of Amazon, right? In fact, my guess is in the last 30 days, we've all used Amazon. They changed the way the retail shopping industry worked. They changed how you got access to something that was different than ever before. And that's what I want to talk about today, because the bottom line is we are in a scenario in America where we have the top 1%, the wealthy, and then there are the rest of the population, where defined as the 99%. But what is it about the 1% that allows them to keep widening the gap from the 99%? Why do the wealthy keep getting more wealthy? And why do the 99% keep losing ground? Well, this is what we're going to talk about today. By the way, I want to tell you that the wealthy don't come in and grab your money. The wealthy don't have a system where you are not able to make any more. And I think sometimes that's a lie of just culture, media, government, whatever it is. But I'm going to show you today how we can change that. So my question to you is, how do you build wealth today? Do you have a retirement account, 401k, 457, 403b, where you're putting some money aside? Putting some money aside that you can later have and use for when you retire. How about a savings account? Put money in there. Maybe you put 20% of your paycheck, 10% of your paycheck. Or how about stocks and mutual funds? Maybe even real estate. How are you building your wealth today? Here's the problem with most of the current financial strategies that I just listed on the last page, is that there are issues with these. In fact, there are three things that, frankly, none of us can control. Market loss. We can't control that. At the time of the shooting of this video, we are losing quite a bit within the market over the last month and a half. We can't control that. We can complain about it, but that's not controlling it. We can't control taxes. We cannot control, no matter who we vote into the office, we cannot control what they do with taxes. And the third thing is we can't control inflation. And so the problem is with, just like taking a taxi where you had to have cash, credit card, you had to settle up when you left no matter what the meter was, just like having to walk into Blockbuster and find the video that wasn't rewound, by the way. I can't believe that people, there should have been capital punishment for that. I'm just saying, hang them up with their thumbs, whatever. But just like you couldn't control those kind of things, it was just kind of what we did, you can't control this. But I want to talk to you about the industry disruptors. Okay, and that's what we're going to learn about here. But not only are there things that we can't control with our financial strategies, here's the reality. Is the question we all need to be asking ourselves is, what happens to my money, whatever I have, if three things happen here? Number one, what if I die too soon? What happens to my family? What happens to the house that they're living in? What happens to the money that was coming in for my job? How about if I get sick during my lifetime? Do I have enough money to cover what my insurance won't? Or what if I live too long? Now listen, I've talked to people every day that are healthy and have lived well into their 90s. There was a few into their hundreds. Unfortunately, the average lifespan of a person is typically how we save. And so what happens if I live too long? Is there going to be more life left at the end of my money? So what are the options? I mean, we know the way we used to do it. We know the way we're doing it now. What else can we do? And this is what I want to show you folks. Something that we're very excited about. And it's called the Legacy Pyramid by Fortis. And Fortis is our name for the services that we're offering with this pyramid. And what I love about these strategies is that they are tax-free, risk-free, and they're insured. Well, let's get into it. Here is the pyramid. Now, if you don't like the pyramid, I apologize. I made it myself, so I hope that it is something that we can follow and look at, because here is the pyramid and the strategies that make up Fortis. Number one, income. Number two, retirement. And number three, banking. So let's get into this a little bit. The question I have for you before we go any further is, what is your greatest financial asset? I want you to think about that for a second. I want you to turn and talk to your spouse or ask this question to your spouse. What is your greatest financial asset? You know, I have a lot of people, when I ask this question, they'll say, well, my house, or my 401k, what I have in retirement, or, you know, my car collection or gun collection, or whatever the case may be. But I want us all to understand something. Our greatest financial asset is our ability, your ability, to make an income. Because without that, it is darn near impossible for you to build wealth. Now let's look at this. What happens if I get sick and I can't work anymore? What happens to my financial plans then? What happens to your 401k if you are not able to work? Or if you're injured? If there's some kind of something that's happened, an accident that's happened, that you are not now able to make an income. I have some very close friends of mine. First year that COVID came out, actually within 60 days of them announcing that it had made it to the U.S., my friend found her husband in the basement, just suffered a stroke. It has been almost 5 years, and he still can't speak, can barely walk, has no use of his right side, and cannot work. See, I want to share this with you, not to scare you, but to make this really obvious to you folks. Every 40 seconds, an American is going to have a heart attack. Every 40 seconds. Every 40 seconds, someone in America is going to suffer a stroke. And this is what I really want us to understand, because I know right now when we're healthy and right now when we're feeling like we're kind of impenetrable and unstoppable, but by the age of 65, 70% of Americans will have received a chronic or critical health diagnosis. And the one thing that is most important to this conversation and to building your wealth like the 1% is we have to protect our income. We must. Okay? So that's the first part, the income. We're going to come back to learn about how we do that, but there's a need. Now, the second piece that we want to talk about is retirement, because this is something that is very, very misunderstood with the folks that I talk to. And I want to dig into this a little bit. Now, first of all, there are three enemies of retirement wealth building. Three enemies: taxes, risk, and liquidity. And I want to show you how that works. First, let's talk about taxes for a moment. Okay? So here's my question to you. And I want you to think about this. What is the future of taxes? What is the future? Are they going to stay the same? Over the course of your saving, building wealth, and living, are they going to stay the same? Will they be lower? Will they be higher? If you are like most people who answer this question, the answer that most people say is higher. Well, let's talk about that for a second. First of all, I think we all understand at the time of this recording, we're in a big debt problem. In fact, the U.S. national debt is over $36 trillion, and it's growing over $1 million every 54 seconds. Every 54 seconds. By the way, who pays that? See, the government can't make money. They can only collect it from the taxpayers. That's our national debt. Do you know what our unfunded liabilities here with Social Security, Medicare, Medicaid, and the like is? Over $100 trillion. I think sometimes they aren't very truthful about how much debt we're really in, and will just post the U.S. national debt. How about tax rates? Well, why would they go up? Folks, whether we know it or not, we're in the lowest marginal tax bracket in the last 50 years. The last 50 years. Does not matter who is in office. Taxes are going to have to increase unless we want this and other things to continue to go like they are now, which is running very fast into a train tunnel with a big light on the other side. How about the Congressional Budget Office? And this is, I think, one of the things I talked about with our unfunded liabilities here in America. If Social Security and Medicare and Medicaid go unchanged, the rate for the lowest tax bracket, in order to keep the programs funded, they would increase from, this is the current bracket today, 10%, 25, 34.9. 10% would increase to 25%. 25% would increase to 63%. And 39% would increase to 88% tax bracket. That is just to fund our unfunded liabilities with Social Security, Medicare, and Medicaid. Are taxes going to go up? Or are taxes going to go down? Are they going to stay the same? I think we all know the answer to that. So then, with that in mind, I want to talk to us about the three different strategies that exist out there. The first strategy is the taxable strategy, and it is forever taxed every year, what they call tax as earned. Or we have the tax deferred strategy, which is tax at distribution. Now, this might be 401k, this might be, 457, 403b, some other type of deferred where they don't tax it right away. They let you kick the can down the road, and they'll just tax it when you take it out. Also when it's worth more money. And then there's the third bucket, that is the tax-free bucket. This is never taxed. So those are the three options, frankly, the three strategies that we have. Well, which one are you doing? It's kind of ironic that 95% of retirement money exists here in these two buckets. I either have money in stocks, mutual funds, savings account, CDs, high interest savings account. All of those are taxed every year. Or I have tax deferred, which is my deferred retirement accounts. But only 5% have it in the tax-free bucket. Makes you wonder, what is it we're missing? So let's talk now about risk. Because not only the money that we have, that we see, is almost all taxed, or at least that's the strategy we pick, but how does the risk hold up? Well, I want to share something with you. This is average occurrence for the last 100 years. We have three sections: minor pullbacks, and minor pullbacks mean between 5 and 9% of the market value. It's decreased. It pulls back between 5 and 9%. Then we have corrections. Now, corrections are anywhere between 10 and 19% market adjustments. Then we have our bear markets. 20% plus. Okay? And this is the frequency over time that we look at all three of these things. So let's look first of all, 95%. It's as close to a guarantee as you can get. 95%, they happen almost every year, a minor pullback. And recovery typically takes 1 to 2 months. So what does that mean? That means that if you have $100,000 in your retirement account, every year that is going to pull back $5,000 to $9,000 that is going to drop. Then it will recover in 1 to 2 months. Okay? Now, most of us say, yeah, that's not really that big of a deal. That's good, because 95% of the time it's going to happen. Or how about the next one, which is the corrections? Now, this is 10 to 19%. This is a little bigger. That means that $100,000 that you have, you've lost between $10,000 and $19,000 instantaneously or over, the course of whatever it is going down. This lasts 4 to 6 months. And recovery typically takes 4 to 12 months. It's always crazy the difference between momentum and inertia. Momentum is when the markets are growing. They normally don't just spike way up. They normally take their time getting there. It's like pushing a car when it's in neutral. You know how when it's stalled out and you're trying to get behind it, the toughest part is right at the very beginning until you get that momentum. Now, here's the difference between that and inertia. Inertia happens almost right when you run that thing and a force, when it's acted on by another force. I didn't really do well in science class, but it's something like that. In other words, when that car hits that wall, it stops quicker than the momentum getting there. And that's what happens is it will go down, but it takes a lot longer to go back up. And then we're looking at 17% of the time, folks. 17 out of 100 years, we look at a bear market. And that lasts several months to a couple of years. And recovery typically takes 1 to 5 years. Now, if you look at the big market drops out there, 2008, 22, 2000, 2001 during the dot-com bubble, there are a lot of things out there that we look at and we say, those were those were the bear markets. Those were the ones that we all remember. But the things that are also messing with our money is even in minor pullbacks and corrections. You realize that put all of the first two together, or excuse me, the last two, the corrections and bear markets, so anything that's 10% or above, that happens once every 3.5 years, roughly. Now think about that. Once in every 3.5 years. And if it takes a couple of years to go back up, how much is your risk impacting your wealth? So what do we do? Well, I want to talk to you about a strategy with risk, and it's called indexing. Now, I don't want to get way into the weeds with this, and I'm a picture guy myself. So I'm going to sit and look at a picture with you all and try to go over, first of all, this is, I think we've all heard of the S&P 500. The S&P 500, Standards & Poor's, it's the top 500 companies in the U.S. and how they do. And so I want to show you a chart, and I want to give you two different strategies. One is we're going to put $100,000 straight into the S&P 500. And we did this over 25 years from 1999 to 2024. Okay? And the S&P 500 is the red line. Now, we're also going to have a second $100,000, and we're going to plot this out with an indexing strategy. Now, here's the indexing strategy. Number one, you are guaranteed a floor that your money will never go below. In most cases, it's 0%. In other words, if the market were to dip, your principal stays the same. Then they have a cap. So there are some strategies that don't have a cap. Average is about 12% for those that have. Some are lower, some are higher. But basically the principle is we're going to guarantee that in between not losing anything, and we're going to cap you when the market goes up over 12%, we're just going to give you 12%. Let's look at how both of these strategies play out. Now, going into 2000, from 99 to 2000, at the turn, actually, it was a little higher. And so as you can see, the index part, because it was capped, was right about 112,000. The other one was about 120,000. And then as time carried on, you're going to see just in the market, well, here at about 2003, the market dipped quite a bit, and it continued to go down to below about 95%. So you've got there, now you're coming up, and hey, everything's looking good. Everything's looking good. Keep in mind the growth here you can see is starting to, I love what's happening. And then 2008 hit, the housing market crash, and all of those. I'm sure all of us remembered that. And now all of a sudden we are back to where we were 10 years before. Actually worse than what we were 10 years before. And how long does it take us to get back to there? Well, we are somewhere in around 2014, 2013, when we got back to where we were, maybe 2012. And so, we're going to see this is part of life. This is part, right? But what do they say? You never get hurt on a roller coaster unless you jump off, so just ride it out. Okay, all right. What do you say to the people here in 2008 when they were going to retire and all of a sudden lost 40% of their value? What do you say to them? Hey, just keep working for 4 more years until it bounces back to where it was? So as you can see here, most of it is up, but it will correct down. Comes up, corrects down. The difference between the indexing strategy where, hey, we're not going to let you do these huge peaks like this much. We're going to kind of cap it at 12%, but if you notice the years that it went down, they didn't lose anything. You mean to tell me this person could have retired in 2008 if they had had an index strategy? Absolutely. And if you look at that $100,000, folks, this is based on the last 25 years. I'm not making these numbers up. These numbers are published. If you look at this, that 100,000, because of the slow and steady wins the race, look at the difference here. Look at the difference. 415,000 to 552,000. That is a significant increase. And the key is, again, risk. That. How are we avoiding that? Now, let's look at liquidity. We've talked about taxes. We've talked about risk. How about liquidity? In other words, how liquid is our money? How easily can we get to it? So these are the types of strategies that people that I talk to have. I mean, the first ones, obviously, it's your pension, your IRA, your 401k, those kind of things. And the problem is with the liquidity, unless you're 59 and a half, you're going to be penalized an extra 10%. If you don't take it by 73, you're going to be penalized 50%. Oh, by the way, every penny is going to be taxed when you take it out. Now, the pros are, the employer most times, or oftentimes I should say, contributes some kind of match. Maybe it's 100% up to 3%, something like that. But the cons are not only taxes, but your money's locked up until 59 and a half. By the way, the average 52-year-old male in the United States has 2 old 401ks and is contributing to a third. Is that the best way to access money when you can't even get to it without penalties? All going to the government, by the way. Well, how about real estate? I mean, real estate's not a bad piece to mix in, but the problem is liquidity. It can take you months to sell or refinance. You have based on, and by the way, if you have all kinds of wealth and don't have a steady income, good luck trying to get something refinanced. You have to lose it. So, some of the pros, you have passive income potentially if you're doing it right. There is long-term appreciation, albeit very slow, and there are some tax benefits, especially if you are financing. But you need capital. You need maintenance, and it's market dependent. What happens when the market's down? What happens when the real estate market is just like, I lost $100,000 in value, and it's just been sitting there. Like, there are things you can't control. And then different private equity, some people, not very many, but there are some that I talk to that do this, and so I wanted to put this in here. The bottom line is we need to talk about the retirement piece, and we need to talk about taxes, risk, in liquidity. So we're going to come back and talk about that, but I want to talk about the third part of our pyramid here, and that is our banking concept. Well, what in the world is the banking concept, and what does this mean? Well, I'm going to tell you. First of all, it's important for us to understand how banks work. But before we dive into that, is this how you bank? That's my question. You give the bank your money. Payday comes, right? And, well, it doesn't really come to you. It comes to your bank account, which means that money is sitting in an account that is not yours. And then you pay your bills from your money that you gave them. And then you save whatever's left over. Right? Kind of sounds like that's the way most of us do it. So here's what a bank does with your money. The first thing is, with the deposit, you deposit, let's say, $10,000 into the bank account. The bank pays you a very small interest rate. Something like 0.15% normally, if they even give you that. And then they use your money to generate profits for themselves. Well, let's talk about that. What does that mean? Well, so we call it fractional reserve banking. So the bank only keeps 10% of what you deposit in reserves. And then they loan out the rest. And so, for example, you put in $10,000, they're going to keep $1,000, they're going to put it in their reserves, just in case people come back and want cash the next day, right? But the 90% they keep, and this is how they make or lend nearly $100,000 for every $10,000 you deposit. And that's quite interesting. So let's talk about what that is. Well, so loans and high interest. So basically that $9,000, let's say someone wants to get an auto loan. Okay, so again, keep in mind, follow me, you put in $10,000 into your checking account. The bank will put $1,000 in reserves and take that 90%. They're going to pay you 0.1% on that. So you might make 17 cents at the end of the year when you get your 1099 INT. And they're going to take that $9,000 and they're going to walk down to the young lady at the other end of the hall who is looking for an auto loan to buy her first vehicle. And so they're going to charge her 12% because she doesn't really have great credit. And they're going to give her that check for $9,000. And they're going to make money on that. Now, follow me what happens here. So now this young lady is at 12% paying every month to the bank on money that was not theirs to begin with. The young lady takes that check and gives it to the auto dealer. The auto dealer then takes that check and does what with it? Well, they deposit it back in to the bank. And then the bank takes that $9,000 check, takes out 10%, which in this case is $900, and they have $8,100 again to lend out. Do you see the cycle? This is how they are making very large profits off of your deposits. Oh, and by the way, let's not even talk about overdraft fees, ATM charges, late payment fees, and the fact that they sell your financial data. Yeah, there are many things they do with this money. And then the fifth step is obviously invest it. And I'll tell you this is the one thing that I want to point out to you folks, because I'm not sure how many of us understand this. Banks invest in what they call bank-owned life insurance, or the acronym BOLI. Kind of sounds like a sandwich, right? I'll take the BOLI with Parmesan cheese. Bank-owned life insurance. In fact, most banks that have over $500 million in assets invest up to 25% of their Tier 1 assets in bank-owned life insurance. Why? Well, because life insurance, as banks know, is the safest place to put your money. They also invest in real estate, other types of investments as well. But I found this interesting because we're going to tie this all in together. Now, look, at the end of this, they rinse and repeat, rinse and repeat, rinse and repeat. And I want to make sure we understand this. Over a 30-year period of time, at $10,000 a month, that's $120,000 a year. That bank in 30 years can earn over 5,000% or more. Folks, that is $600 million that they have made over 30 years on that $120,000 deposited into your bank this year. How does that make you feel? Well, here's another question I have is how can we take advantage of it? Of this concept. What is it? Well, it's very simply called the infinite bank concept. Instead of letting banks profit from your money, let's take our money back. Let's make wealth by doing the same thing that you're doing today. Frankly, all it starts by is just adding one simple step. By the way, I was here dancing with this group. They just didn't let me get in the picture because I am clearly not very good at it. So the infinite bank concept basically is these three things. Number one, you start and fund your bank. You set up and fund a custom-designed, high-cash value life insurance policy. Okay, that's the first thing. Now, the second thing is you use your bank and recapture your interest. So you use the cash value in the policy to finance your purchases, your investments, and your business growth instead of relying on a traditional bank that you have to go back and take out a loan every time. And then the third piece that allows you to do is scale and pass down your wealth as you build your wealth, as you build your legacy, and it keeps it protected from taxes, lawsuits, and market downturns, or, as we talked about, risk. So I want to ask you the question, do you want to invest and do you want to handle your money like the 1%? Well, if so, that's why we have Fortis. And the three phases of Fortis basically are the three levels of the pyramid: income, retirement, and banking, protecting the three phases of your tax balance wealth building strategies. I want to thank you guys for watching this video, and I know that there's a lot of information here. But if any of this sounds like something you want to explore further, again, we're talking about industry disruptor. Taking money back, protecting it from the government, protecting it from when you need it the most, and allowing yourself to build wealth generationally for not just you, but for your children, for your children's children. This is something that people have been doing for years and years and years. The wealthy have figured it out. The wealthy have been doing it, and we want to be able to now introduce this to the 99%. So get a hold of the person that referred you to this video. If you would like to know more, we can set up a conversation. And thank you folks very much for your time. Look forward to speaking with you soon. Bye now.